Thanks for watching. This video is meant to be a step-by-step guide for how to buy your first multifamily rental property. We will cover some of the things you need to know, issues to avoid, and how to prepare for your first investment property. Then you can take this information, research some more, and find the right property for you. Please watch the whole video, as there are interesting tips towards the end. Before we start with the step-by-step guide, please remember to like the video below and subscribe to this channel. Thanks for your support, this helps us continue to come up with new interesting content. Let's start at the beginning, so you have decided you want to buy a rental property. There are a few ways to prepare both on the research and decision-making processes. Step 1. The first step is you need to ensure you have a down payment. If you haven't started your down payment savings effort yet, please continue to watch, as there are some interesting topics you need to know anyway, as you consider rental properties for the future. Lately, I see a lot of requests for how to buy real estate with no money down, or how do I get my first property with no money down. Keep in mind, leverage is an interesting and powerful tool, and can be used both wisely and poorly. There are ways to achieve low money down options, using private money or hard money lenders, but those topics won't be covered by this video. I will include in future videos. Here we are focused on the person or couple who has saved a down payment and is looking to buy their first rental property. As you plan your down payment, you start with knowing how much lenders require. Most lenders historically wanted 15 to 20% down, pre-COVID. Now lenders are looking for 25 to 30% down for multifamily rental properties. The size of the building is where these criteria will change. If you are looking at a multifamily building with 4 units or less, the criteria is pretty standardized, as these are typically conventional mortgages, backed by GSEs like Fannie Mae or Freddie Mac, where the mortgages are insured and or backed by investors. Also, if you are going to be owner-occupied, which means you will be living in one of the units and renting out the other 1 to 3, this also will impact the terms of the deal. Some lenders think of these as true residential loans and give the borrower more flexibility with the down payment. However, keep in mind, anything less than 20% will be charged PMI until the LTV requirement is satisfied. If you are looking at 5 units or above, this is what is referred to as a commercial mortgage. These mortgages are underwritten differently with different practices per lender. Suffice it to say, that the cash flow and operating metrics of the building will stand on its own and determine the down payment amount. In the deals I've done lately, the down payment is 20 to 25% of appraised value. Lenders also may require additional reserve funds depending on your experience or relationship with the bank. A reserve fund is up to 90 days of principal and interest that the lender can draw down upon, in the event you cannot make the payments. This is something more prominent as a result of the pandemic. I will do a separate video about securing your first commercial loan, and how the process works, as that would be for a different audience than this video. But back to down payment, if you have $50,000 to $100,000 saved up, then you should be thinking about your budget, and target size building you can afford. After getting to know your lender's down payment requirements. So if your lender has a 20% down requirement, take your $100,000 divide by 20% and this is your top end of the range of buildings you should be looking for. Warning, this doesn't mean you can afford the building or the property is now a good deal. This is just helping establish basic criteria for narrowing your search. So if you're at the very beginning of saving with $6,000 saved right now, keep saving and learn the next steps to prepare for buying your first rental property. Step 2. If you have the down payment, and are ready to go on a property, and will need a mortgage, or even if you're still in earlier stages, you are going to need a lender. I normally engage my lender regularly to find out about what is going on with interest rates, any new programs, and their timeliness to close. If you are working in real estate, your lender is a key partner in the process. But for your first property, I would recommend to use one mortgage broker, and a few banks or credit unions to find the best rates and terms. Each lender has their own risk appetite and lending programs. They have different fees and other costs. Compare each of them prior to committing. The lender will ask for the terms of the deal, purchase price, taxes, insurance, and other expenses, plus income items like rent rolls, and start evaluating the opportunity. At the same time, the lender will also be evaluating you and your credit. If you are not in contract, or at final stages of the deal, ask the lender to hold off running your credit prior to formalizing. Since you don't want your credit score getting pulled each time, have a ballpark of your credit score to share with the lender. Be prepared to share your tax returns for the last 2 to 3 years, 60 to 90 days of bank statements, and a personal financial statement which highlights your assets, debts, and liabilities. Tax returns are a way lenders evaluate your ability to generate income. If you have historically been in a position where your taxable income is super low, you may have trouble securing a loan. Copies of any of the underlying information may be required or additional follow-up, so be ready to share. You don't want to lose a deal or financing as a result of not being prepared. Assuming you have credit and a lender to work with, you will also need good credit and a history of being a good creditworthy person to lend to. If you don't have credit, you will need to establish credit prior to this process. Please research on YouTube ways to improve your credit score if you fall into this category. Step 3. If you haven't already, finalize your property. The property search is a key part of this process. You need to find the right property for you and evaluate it. The prior 2 steps were to narrow your criteria. This is now to target and secure a property for you. When it comes to multifamily properties, I review about 10 to 20 deals a week. There are countless other opportunities I don't even waste time on, because they don't meet my criteria. The deals I review, I run them all through a quick review, and then more thorough analysis if it passes the first test. If you are searching with a real estate agent, set your criteria. It may be based on price point, property type, number of units, location, cap rate, gross rents, or whatever other criteria you have established. But you need to filter down the amount of information you receive, so you aren't in analysis paralysis. Unfortunately, with your first property, it is a risk and unknown. So many people get bogged down with the question, is this the right one? Then they evaluate another, and another, and another, but never get off the starting block, and just spend time evaluating. Personally, I rarely waste time seeing the property in person, prior to evaluating the deal, and coming up with an appropriate offer price. I then compare my valuation to the asking price, and if I am in same ballpark, it's worth further discussion. Otherwise I move to the next one. If you are a long-distance real estate investor, it is impossible to look at every property firsthand prior to making offers. Good deals often won't last long enough for you to get there in person. Step 4. Which is actually part of Step 3. Evaluate the deal. I determine the estimated mortgage using a simple amortization calculator, which you can find online. If it's your first property, you are likely using a fixed 30-year mortgage with 20 to 25% down. If you don't have an idea from talking with your lender, you can estimate the interest rates from websites like bankrate.com. Once you get the estimated mortgage costs, then it's time to plug in the other factors. Plug in all of the associated expenses and income into a spreadsheet. Expenses include your estimated mortgage, taxes, insurance, utilities, property management fees, and maintenance and repairs. Taxes can be estimated or looked up on Zillow or the county or city website. In multifamily listings, this information is normally disclosed on the listing. Insurance. I would connect with a local insurance agent who can guide you through the process. On multifamily buildings, the ranges can vary, and you want to make sure you have enough property and liability coverage. This is an area not to skimp. Utilities. These depend on how the property is set up. Utilities may be on the owner of the building, or it may be a responsibility of the tenant. Ask for copies of the bills and leases to determine the cost. Property management is key to real estate ownership. See our video on property management above. New investors tend to skimp on their allocation to property management fees. Get a quote, or if you plan on self-managing, estimate the amount of money you want for your time. Spoiler alert, 5% is often not enough for property management. Repairs and maintenance, depending on the type of property and condition, this will vary greatly. I use 7% as a starting point and adjust from there. Some buildings will require more annual upkeep, and you should model that accordingly. Income items are monthly rents, laundry fees, parking fees, pet fees, and any other income that you will be able to collect. It's important to evaluate the deal after deducting a vacancy expense for the time that units are not rented, and/or the cost associated to fill the unit. Vacancy varies by city, state, and region. 5% is a minimum starting point, which says you will turn over the units and be vacant for a little over 1 month out of every 2 years. If you are going to be turning over the building and increasing rents more frequent, this number may be higher than 5%. When you have your annual income, net of vacancy, and your annual expense, you subtract the expense from income, and this is how you determine your net operating income. Your NOI is a key starting point for multifamily investing from here. This is how you start your cap rate analysis. If you don't have all the expense items and are looking for a quick NOI calc, a 50% expense ratio can be applied to rents to get your NOI ballpark. If this is your first investment, don't make any offers based upon this number, as the actual NOI can vary greatly. See our video above on how to calculate cap rates. Simply, cap rate is the NOI divided by the price. Cap rates are the starting point for evaluating deals. Other metrics to consider when evaluating are cash flow, monthly cash flow per door, cash-on-cash returns, DSCR, and ROI. There are more sophisticated approaches to use over time with IRR, comparing your returns to risk-adjusted comparisons, DCF, NPV, and other tools, but on your first property, you should keep it simple. On your first deal, you should have healthy enough margins, or a slightly higher cap rate, to account for a WTF factor, or buffer factor, that you are likely going to incur. Step 5. When you find the right property, or right location for you, after you completed your careful analysis in step 3 and 4, you will eventually determine what you think it's worth. Then it's time to make an offer. Make your offer based upon your own return criteria, not what anyone else advises you, or if someone is pressuring you to increase the offer. Let the numbers speak for themselves. Then, make the decision and pull the trigger. Good deals can go fast. Also, don't be afraid to let a deal walk when the counter or other terms change, which can move outside of your appetite or make it a bad deal. If you get an accepted offer, you will be moving into contract, so engage your attorney and other professionals to start the process. Step 6. The due diligence period. This is your chance to get additional information that wasn't provided. Leases, applications, utility bills, tax bills, and any other items that were not easily accessible from the seller. Most importantly is inspections. You should get a great inspector. On one of my first multifamily deals, my inspector found up to 20,000 in issues that I wouldn't have been aware of as a new investor. We were able to get credit at the time of closing for these issues. Without a great inspector, I would have to pay for 100% of the cost of these repairs. Just to reiterate, I've closed on multiple multifamily properties and still use my inspector on every deal. Don't make the mistake and think you know everything and can save the money. It's penny wise and pound foolish. Sometimes people are selling for a reason. For example, they don't want to buy a new heating system, or roof, or whatever. Major issues can be identified by a licensed inspector that a first-time investor may miss. Always, ask for a seller price reduction or concession at closing for any findings. If there are any changes in terms during due diligence, and they are agreed, work with your lender and attorney to get this deal to the closing table. Step 7. Close the property and rent. Acquire the property, list it, and rent it. If you plan to self-manage, this is where you will determine if real estate investing is truly for you. Showings, listings, connecting with tenants, screening, background checks, applications, and more. All of this takes time and effort. For my first property, I used a technology-enabled management software to help list the property on 30 different sites, accept applications, communicate with applicants, schedule showings, and more. However, there was still a lot of time and effort required by me as the owner. I laugh now when I hear rental properties referred to as passive income, especially for those who plan to self-manage. But these online tools are helpful. Other examples of online tools offered by this platform: lease creation, online payment, and more. For those interested, this software was called Avail. This isn't a free software, but it's worth it. If this sounds like a lot of work, you can also save time by listing with an agent who will do a lot of this work for you. Again, review our video on property management tips if you are considering self-managing. No amount of technology solves for every issue. This is where profits are made and lost, so it's important to know what you are doing. Please rewatch the video above on property management. Step 8. Track your progress. Use reporting tools, like Stessa, to help track your income, expenses, and net cash flow for your business. Evaluate how you are doing financially. Evaluate how you are doing mentally, and physically as well. This can be stressful. Multifamily investing isn't always for everyone. Many times, folks think it's right for them, and then they start dealing with the property management issues and realize it's not as easy as they anticipated, or the returns aren't as strong as expected. Seek advice and guidance from those further along in the multifamily space to help guide or mentor you. They may see mistakes you are making, or be able to give quick guidance to help. If things are progressing nicely, and you are ready to add more properties, repeat the process. I will do another video on the scaling up process, and strategies for building a portfolio of multifamily properties, leveraging expenses, managing more than one property, tenant issues, and other property management tips and tricks. I am always available if you want to like and subscribe, or comment below. I can help answer any questions you may have in the process. Thanks again for watching, and please like and subscribe to the channel.